The NHS pension is still, in our opinion, a great deal for the vast majority of us. But due to recent changes in the NHS pension, if you don't want to work to state retirement age, you have a bit of a problem. So today we thought we would talk about something that is really, really common on our financial wellbeing course, which is how can I retire early using the NHS pension? And to do this, we have, of course, one of the best experts in the business, Mr. Andy Pow. Everybody knows you, Andy, but do you want to give yourself the intro?
Yeah, hi everyone, I'm Andy. I've been working with Medics Money now for a couple of years, but actually for the last 30 years I've been advising doctors in all things financial.
I know what you're thinking, YouTube. He doesn't look old enough to be advising for 30 years, and I agree. You're looking good, Andy, in your peri-retirement, are we calling it?
Oh no, this is just a dip. I'm coming back out of it. I'm going to be doing lots of things.
Awesome. You were retired for like 6 months. I like that. But seriously, right, I think this is quite a big thing that a lot of doctors are sleepwalking into, and B, on our Medics Money Wellbeing course, this is a really common goal for the doctors that are on our course. You know, for whatever reason, doctors don't want to work until state retirement age anymore. And if you don't want to work to state retirement age, the NHS pension is still a great deal, in my opinion, but it does have this problem. So let's get into the problems and, more importantly, the solutions.
Yeah, okay, so the NHS pension is a fantastic pension, and I can't remember the number of times you've asked me, Tommy, would I be in the NHS pension if I could be? I can't. I've never worked in the NHS. Luckily, my wife has, and she's in the NHS pension, and she stayed in it throughout her whole career, which is fantastic because it's making her retirement plans a lot simpler. But yeah, I would, and most of the advisors I talk to, if they have the opportunity, would be in the NHS pension scheme because despite the changes, and we'll go over some of the changes that have happened, it still remains an exceptionally good scheme. You know, it's backed by the government. The difficulties around actually planning about it is perhaps a downside, but we can sort of talk through some of that as well. It's getting slightly easier with the 2015 scheme to plan, but yeah, even with early retirement factors, it's still an exceptionally good pension, and it provides lots of other benefits as well. Hopefully, the ones you won't need, but in terms of family protection. But we're not going to talk about that today.
Yeah, absolutely. But I think the thing that maybe a lot of people haven't realized is that the 2015 scheme. So let's talk about retirement age, because that is a big change. And I also think we haven't felt the effect of that because, like, I'm watching colleagues retire now who are on the 95 scheme and they're retiring at 55, 60. That is not going to be realistic for anyone in the 2015 scheme who just follows the default path. So if you want to work to 67 and 68, no worries, you can tune out. But if you don't want to work till 67, 68, let's talk about how the retirement age has changed over the years and the effect of that.
Yeah, so effectively going back to basics, we've got three different parts of the pension scheme. We've got the 1995 section, the 2008 section, and the 2015 section. We're going to talk a lot about the 2015 section because from 1st of April 2022, everyone has been contributing to that going forward. So the old 1995 and 2008 sections are still live in some aspects, but you're not contributing any further years worth of service to that unless you've got some old style added years benefits. But I suspect a lot of people won't have those these days. So we've got three different types of schemes and how they've changed really. They've changed in how the pension's calculated, but secondly in terms of what's called the normal pensionable age. And normal pensionable age is the age you get if you get your pension at normal pensionable age, you don't get early retirement. But if you, in all three schemes, you can go early. There's no problem with going early. So this whole mindset of, I've got to work to 67 or 68 because I'm in the 2015 scheme. No, you don't. You can still go early, but you just have to bear in mind there are factors that apply to your pension. And the earlier you go, the more the pension is reduced. There are other things as well. You know, people that want to carry on working, actually, things like the 2015 scheme will actually have a reverse of early retirement. You get late retirement factors applying where you never got that in the 95 scheme. So that has been, probably the biggest change is how that's moved. But as I said, it's not the worst thing in the world because actually it can be planned around. And we have to go back to basics here and just remember a pension. What is a pension? A pension is a saving for retirement. okay, to give you income when you are not working. And that saving can come from a multitude of different sources. It doesn't have to be from a pension. It can be from ISAs, it can be from, cash savings if you're, particularly cautious about things. But actually the pension, probably for those working in the NHS, that's the core part of it, which we'll go on to.
Yeah, and I definitely don't disagree with the NHS pension being the core of your retirement plan. But I think what's changed is that maybe 20 years ago, as a doctor, you didn't even need to think about anything else. You had a final salary pension, which you could take at 55 if you had special class status, or 60 otherwise. And probably you didn't really need to worry about anything else. But now, in my opinion, and I'll definitely be keen to hear your opinion, Andy, if you don't want to work until 67 or 68, you at least need to understand the effect of these actuarial reductions, model it for your own circumstances, and then think, okay, maybe I need the NHS pension plus something else. And we're going to talk about that something else in a bit. But would it be useful? We've talked about these actuarial reductions, which is basically, as you said, you can take the pension early, but it is actuarially reduced for each year that you take it early. And so it's really important to understand the effect of that on your own personal circumstances, because some people, they might take it 5 years early, actuarial reductions, no problem, and they're totally happy with that. But everyone's circumstances are different. And that's something that we cover on the course. Link in the comments if you want to join the next cohort. But should we have a look at that?
Yeah, so I've just pulled up on the screen. These are the early retirement factors as at the 1st of April 2024. Now, just a caveat, if you're watching this in 6 months' time, these could have changed slightly. They do get modified from time to time. They do get reassessed. Don't change a lot, but the decimal points can change. But these are the factors in play at the moment. And you can see across the top, we've got 3 years. We've got 3 schemes, 2015, 2008, 1995. And you can see there the effect of retiring early. Now, I've not built in any kind of late retirement factors in the latter schemes, but in the 1995 scheme, there isn't late retirement factors. But say in the 1995 scheme, if you're age 60, basically that's the normal pensionable age, and therefore you get 100% of the pension, so the factor's 1. But if you went at age 58, it drops down to 91.7% of the pension you've built up. So effectively how it works is they work out the pension as it would do normally, and then they apply that factor because you're going 2 years earlier. If we move across the two schemes, at 2008 it jumps to 65 being the normal pensionable age, and in 2015 scheme it's currently 67, but it is actually linked to the state pension age. It isn't actually a date, a year. So if the government decides to change the state pension age, then automatically this will change the whole of these tables. So when it goes from 67 to 68, as it will do for some people, effectively in that 2015 scheme, all those years will drop down 1, and the 68 will replace 67, etc. But say you went at age 60 in the 2015 scheme, again you calculate your benefits as you would normally do on retirement, but you would only then get 71.1% of it at that point in time, because essentially you're going at the moment 7 years early. 2008 scheme at age 60 you're getting 79% because you're going 5 years early. So you can see all these factors are quite significant. They do drop down, but it goes back to core pension planning should be around about looking into retirement and looking what you need to live off. So we'll perhaps illustrate this in a minute, but if you're say you want to go at 65 and it's around about 90% in the 2015 scheme, if your pension was normally 70,000, you're applying 90% to 70,000, it gives you a pension of 63,000. So it's not actually necessarily the reduction that matters, it's the deduction on what you're basing it on. So the longer you're in, and really we'll come on to perhaps early contributions are really, really important in this, because they build up this pot for you. The longer you are in, the bigger pension it's going to give you, but the more opportunity it gives you then to apply early retirement factors and go early, because you've built up a big notional pot.
Yeah, absolutely. Can we look at the spreadsheet, right? Because we love spreadsheets, you love spreadsheets. We built a spreadsheet for those on Medics Money Financial Wellbeing course. It does a whole range of functions, calculates your adjusted net income, gives you a summary of your budgeting, how much you're saving. But one of the most powerful tabs of the spreadsheet, in my opinion, is this one here. So Tell us what we're looking at, because this is just beautiful.
So this is a little spreadsheet we've just designed. It does not, and I will say, this does not replace financial planning. It does not replace fully modelling your pension, but it just gives you some ideas of dynamics that are going on. But essentially what we're doing here, and you can set it up for the 3 different sections, but we're just going to concentrate on the 2015 scheme because that's where most people are at. What we do is we can put the age you join the scheme. So I've just put age 30 in this case. I know people join earlier, but let's just say age 30. We want to put in the age you want to retire at and the normal retirement age, which in this case we're just defaulting to 68 because we're starting quite a way off. And essentially what we can do is we can populate. So the way the 2015 scheme works, it's based on your pensionable pay in the year divided by 54, and that works out what the pension is. But what also happens in the 2015 scheme, once you move on to the second year, the first year gets uplifted, and it gets uplifted by 1.5% plus the CPI inflation rate, Consumer Prices Index inflation rate. So the good thing about the 2015 scheme is that it is inflation protected. So all those concerns about, your pay not going up with inflation, etc., actually doesn't apply to that part of the pension scheme. But we've taken the inflation out of this. Okay, so we've taken inflation out of this. We've just applied that 1.5% factor. So we've assumed inflation is 0% for 38 years. It will still get compounded by 1.5%. And we can just see on that first line there, someone earned, age 30, £40,000 of pensionable income a year. Actually, the equivalent value on retirement, ignoring inflation, is equivalent to a pensionable salary of 70,000. So it's near enough almost doubled in value without actually having to pay any more. And you can see, some of these earlier years, where you're earning at lower levels, suddenly jump up to being quite huge amounts equivalent now. So that's the equivalent pay now you would get. So really, it just kind of illustrates. That's the useful thing about illustrating the fact that the compounding bit is really, really important. And if you are thinking of dropping out the scheme, particularly in your early years, you have to be really, really careful because you're losing a significant amount of value in your scheme. And the idea is effectively to build up as big a pot as possible, because then you can start applying early retirement factors. So these are totally hypothetical earnings here. So we just populate the earnings. And the formatting just changed slightly because I'll have to go and change that. But put earnings through to age 68, and age 68, starting at 30, that's going to give me a pension in today's terms of 91,000, which seems an awful lot. So let's say, how many years let's say this is you, Tommy. When would you like to retire? Let's just you choose realistically.
Yeah.
I know you want to retire tomorrow, but realistically, what age would you like to retire?
Actually, I don't want to retire tomorrow. I'm really enjoying being a doctor right now, but I know that lots of people aren't. So let's just say I want to go 10 years early. So I am linked to the state retirement age for me is 68. So put me down for 58.
So we're going to just change age of retirement to 58. Okay, and what I'm going to just do is just delete all the income from 58 onwards as well. I'll take that out. So remember, previously, age 68, your pension was 91,000. Okay, it's now dropped down to 35,000. And the reason is 58 is just a no-no because of massive early retirement factors. So it does make a huge difference. Okay, it really does make a huge difference. But what we need to bear in mind is the starting point is actually, did you, if you're looking to retirement now and it was producing a projection of 91,000, do you actually need 91,000 in retirement? Probably not. I suspect not. You might think so at your age when you're still out throwing yourself out kite surfing and buying the latest boards and latest kites and travelling with young kids. You might think you need a lot of income, but let's be realistic. When you're older, maybe you won't be doing all those things as much, and hopefully your kids are free and you've paid off your mortgage. You won't need as much income. So I'm not saying a drop to 91,000 to 35,000 would be realistic. But let's say, and that is because we're going in, but let's just put a few more years in. Let's take you to 62. That's a 62.
Maybe you could put me dropping down to 30 or 40,000 for the last 5 years, really winding down.
Okay. So let's stop and start again. So let's just say at 58, Tommy, actually you want to carry on in a part-time capacity because actually you still got a bit of life in you and you want to go out there. Let's say we drop you down to half-time at that point in time and carry on working, say, through to 62. So we'll put 60,000 of earnings through to age 62. Ooh, better put that one in there. And let me just change your retirement age now to 62. Okay, and as I said, this is just for illustration only, doesn't replace financial planning. Pension is now 48,000. Okay, that's not so bad, is it, as a pension? So it's a good starting point. So it just kind of illustrates you don't have to stop altogether. You can just start reducing down. It still continues to grow. It just means you get a combination of increased pension because you've had more years of income going in, but equally increased pension because those early retirement factors drop down. But as I said before, pension planning isn't just about the pension. Retirement planning isn't just about the pension. So, if you've got an idea that actually, I've got 48,000 built up, and actually I do want to go at 62, and I do want to drop down at 58, but actually I know, I probably need about 60,000 to live on comfortably in retirement. Everyone's circumstances will differ because you'll have different partners, different, household costs, different aims in terms of travelling, etc. But say you needed 60,000, then at that point in time, you've got to look at what options there are to top things up.
Yeah, we're going to talk about options to top up because I think that spreadsheet is just so powerful. You can play around with your own numbers and think about what you need and then how you fill that gap between your desired retirement age and the age which the pension is giving you what you need, right? So we're going to talk about how to fill that gap. I just want to loop back to something that you said, because one of my biggest concerns at the moment with the pension is that a lot of junior doctors are opting out. And I get that because they've had savage real terms pay cuts at the time of recording, although maybe the new government might have fixed that by the time this goes out. Let's hope so. And they just can't afford the contribution. And I can totally sympathize with that position because the first couple of years of my career, I was flat broke, had terrible credit card debts and was in a financial mess. Hence, started learning about my finances. But those early years are the most valuable pound for pound contributions because as you showed on the spreadsheet, they just compound effectively those early years. So the early years, pound for pound, the most valuable years of your pension because it just gets revalued all the way through to retirement. Is that right? And what's your take on people like leaving?
Yeah, absolutely right. If you imagine 30, again, bear in mind that example doesn't include inflation in there. That was purely at 0% inflation. Every year in the 2015 scheme, your pension is going up by 1.5%. Even if inflation is 0%. So you apply 1.5% on 1.5% on 1.5% for 30 plus years, it makes a huge difference. It is a big cost. Well, but what you have to bear in mind is your employer's also contributing an awful lot. You might be paying, 10% or whatever, but actually the employer's contributing over 20% now. And that gets reassessed every few years. So if you drop out the scheme, you're effectively losing that part of the benefit unless for whatever reason you can negotiate with the employer that passes to you. It does apply slightly differently for GP partners. Before anyone puts that in the comment, I think GP partners understand how it works. They have to pick up both costs. But yeah, absolutely, it's really, really important to start early. But so, I get why people, are dropping out, particularly with current, industrial disputes that are going on and people's earnings be affected and people's earnings not keeping up with inflation. And therefore, you've got to kind of pay for today, and therefore putting this off for the future is quite, an easier option to take. But if you can, if you're looking at cutting out certain things in life, try and make sure that the pension is the bit that you don't cut out if you can. And I know that's not going to be possible for everyone, but yeah, it's really important to be in for as long as possible because you will thank yourself in 30 years' time. When you're seeing your colleagues, going at 62, 63, and you're thinking, I've got to carry on to 68, 69 just to have enough income through retirement, you will thank your earlier self then for making that decision.
Yeah, definitely. And I don't want to keep going over the spreadsheet because I love playing with it. But if I play with it in my own situation and say, okay, for the first 5 years of my career, I wasn't in the pension, the effect on my final pension is absolutely catastrophic. So Yeah, times are hard, and I can sympathize with that because I've been through hard financial times myself. But I've never regretted staying in the pension, even though I had debt, drowning in debt. So, yeah, I think that's a really important message. Okay, so you've done that, you've modeled your numbers, you've got your desired retirement age, then you've got your pension actual retirement age, and you've got this gap, right? So I think in the example that you used, we had like a 12 grand gap by going early, okay, per year. How can we fill this gap so that we don't have to work all the way till the end?
So we'll talk firstly about the NHS bit, and then we'll talk about considerations outside the NHS. But within the NHS, there are kind of three different options to think about. The first one is quite quick because that was something called added years, and to be honest, there have been no added years contracts since March 2009. So if you're 30 or 40, you're not going to have taken an added years contract out, and you won't be able to. But there's a few people, perhaps in their 50s, that still have these. And effectively, added years will buy you. If you're having 1 year's worth of service, you could have bought extra years of service. But that doesn't apply anymore. The second area, if you're looking at topping up the pension, you can buy additional pension within the NHS. And actually, I'm just going to flick again to. They've just updated this. It's an additional pension calculator. So you can buy an additional pension within the NHS, and you can buy it in blocks of income, effectively. And these are blocks of income based on normal retirement age. And those blocks of income are anything from £250 to £8,575. But on the NHS Pensions website, and we'll probably drop the link into the notes, there is now an additional pension calculator, which you can it's quite easy to use. You click in Start Now, you put your date of birth in. Let's use their example, because why not? 1984. Do I have any extra additional pension contracts? No. How much pension would I like to buy? I'm going to want to buy £2,000 a year of pension. Continue. Do I want dependent cover? So this is adding an extra level of life cover if you need it. I'm just going to say no at that point in time. Then it asks me, do I want to pay it as a one-off payment, a lump sum, or regular payments? So regular payments will be, depending on the number of payments you want to make, either yearly or monthly, and the number of years you want to pay it over. But let's just say a single lump sum payment might be quite useful for those people that, we've talked about previously on lots of things about marginal tax rates, and particularly that 100,000 tax band might be a consideration. If you say we're at 105,000 and you wanted to reduce below 100,000 of taxable income, you might want to make a single lump sum payment to get you below that. So we'll just click on continue. So it's just asking me to confirm, and basically it calculates what I'd have to pay to get that extra £2,000 of pension. Okay, now bear in mind that is also then tax deductible, so it reduces, the tax comes up, so it does reduce things. So that's just one way, and it's quite a good little illustration, really, and it can link through to the actual fact sheet, which gives you all the details about that as well. So have a play around with that and see if it's worth you considering, really. So quite easy to do. The other thing to think about in the pension scheme is something called ERBO. And what ERBO is, it applies to the 2015 scheme. It's called an early retirement reduction buyout. And effectively what this is trying to do for the 2015 scheme is allowing you to buy out those early retirement factors that would apply after age 65. So if we went back to our example, at 65 in the pension in the 2015 scheme, you get something like 85% of the pension. But taking ERBO is basically giving you 100% of the pension at age 65. So it's something that you basically commit to for the in terms of additional contributions to buy that additional buyout. So that's another way of playing around with it. So those really are the two options within the NHS scheme. But I wouldn't also discount stuff outside the NHS scheme as well.
Yeah, and are we going to briefly cover options outside? I mean, there's so many, isn't there? And really, we go into detail in this on the course to allow you to decide what the right option for you is, because we keep saying it, but everybody's financial situation is different. And so it's totally impossible to say this is the best option. It's really about the best option for each individual. But the aim of the course is to give people the knowledge so that they can make the decision themselves. And of course, a good financial advisor would also help you with this. But other options, we're going to get into like SIPs and ISAs or...
Yeah, so if we just go back to that example we were using as you, who had a pension, I think at 62 of 48,000, but you need 60,000 to live on. One of the factors to remember is eventually state pension will kick in, so you will get a state pension at state pension age. So let's say that state pension was 12,000, just for example. At state pension age, your pension goes from 48,000, therefore, to 60,000. So at state pension age, you're fine, But those years before state pension age, you've got a shortfall in what you need to do. So say it was £12,000 per annum for 5 years, okay. Essentially, you're then looking at plugging £60,000 of income over that point in time. So what options do you have? Options you have include you can take a pension outside the NHS scheme, so something called a SIP, a personal pension plan, and you can do those in single premiums or you can do those in regular savings. You do need to caveat that. You just need to have checked your annual allowance headroom for that you're not going to any allowance levels, but that's really going to probably apply to consultants and above or GPs who are partners. But just have a check of that. But assuming you've got headroom for the annual allowance, you can top that up. At the moment, we don't have any lifetime allowance applied, which previously was a cap on how much you could put into your pot. That's gone at the moment temporarily. Bear in mind, governments can change things at any point in time, albeit the Labour government have said in the manifesto, or they didn't say in the manifesto, but they said in the preamble to their manifesto that they weren't going to bring this back. But all this could change. So private pension is an option, useful in that it gives you tax relief as it goes in. Downside is you pay tax when you start to take it out. So you do have to bear that in mind, but quite useful again in that marginal tax planning option. If you look at someone like me, my pension or my retirement plan is a factor of a couple of things. I have a private pension because I can't be in the NHS scheme, which I've built up over the years, but I've also got ISAs. And ISAs are basically a tax-free investment pot that you can either put cash in, you can put shares in, you can put a combination in now of cash and shares. But I've got an ISA portfolio, and my wife's also got an ISA portfolio, which I've built that up over the years. With an ISA, what goes in, you don't get tax relief on it. So it's not going to change those marginal tax rates, and it's going to change your tax bill. So it is paid out of post-tax income. But what you take out is also then tax-free. So there's no tax implications of taking out. So going back to that example of you, Tommy, you want £12,000 this year, and we'll ignore tax on the pension as well because the pension is taxed, but just say you want 12,000. Well, if you had 5 ISA pots at 12,000, that gives you 5 lots of 12,000 top-ups. You can draw down, and you can draw those down at any point in time, so they are useful. Younger people can look at lifetime ISAs, slightly different in that there's a bit of tax. Well, the government puts a tax top-up into that pot. You're restricted to actually how much you can put in, but the government tops it up, but you can only take it out for a couple of circumstances. One is retirement, and the second is buying your first house. So that's an option as well. And then there's a whole range of other investments you can do. These are more, building up unit trusts and all kinds of different investments. So there's lots of ways outside the NHS to do it. And, what's right for you won't be right for me. We will have different aims, different ideas of what we want to live off, different ideas of flexibility of when I want to draw it down. So that ISA thing for me is great because I can just I want that lovely holiday that I want to go on, to New Zealand and Australia for 2 months. Then actually I might need a bit more cash so I can draw it down off my ISA, whereas a pension would be less flexible in that route. So yeah, lots of things to consider.
Yeah, all those options flowed off your tongue because we've literally just done a session to the course on this where we go in detail. But it's just about understanding the pros and the cons of every single, all of these options have pros, definitely, and cons. And it's just about understanding them and trying to model them into your own situation. I guess what we should also say is, if you've got to start early on this, okay? So yeah, it's no secret that I do want to have the option to retire early. And so I probably started thinking about this seriously and making an active plan about age 38, 39. If you're 40 or over and you haven't even considered retirement yet, and you know that you don't want to, or you want to have the option, should I say, to retire early, you got to start now, because there's no get rich quick schemes here. There's no quick fixes for this. The earlier you start, the better position you're going to be in. And, speaking from my own personal experience, I have a plan. I know the numbers, it's all modeled out. And just having the option to retire early, it feels amazing, because I know that if I get to 58 and I want to go, I can go. And yeah, right now, I'm really enjoying being a doctor. So not in a rush to retire, but just having that option. And I just can't imagine getting to 58, seeing someone like me retire, and then looking at your own statement going, oh no, I wish I'd sorted this out earlier. I'm locked in until 68. Oof, that could be heavy. And I mean, I guess you've retired early, Andy, although you've unretired yourself. I mean, what's your kind of thoughts on that and starting early?
Well, to be honest, the number of people I speak to or have spoken to over my career, when they get to that sort of late 50s age and do their numbers, or are confident in the numbers, and realise, actually, I could stop today if I wanted to, those people end up carrying on working, because you're then working knowing, actually, if it gets so bad, or I just don't enjoy it anymore, I can stop. And it just takes that one pressure off you. And it's a huge pressure people to. So actually people really, it's quite good for the NHS, this. I would love the NHS to invest in our courses. It's a big shout out there for people there, because actually this is, we talk about retention. Actually getting your finances organised and understanding your finances is a huge retention tool, because when people are happier, people are confident they don't have to worry about this, they actually end up working longer, in my experience. And it allows you to do different things. So it might be that, if you take my example, I was, and I still do some core accountancy work, but I was a partner in a firm, a partner in a big practice. I didn't want to be a partner anymore. It's a great partnership, but it wasn't for me in my personal circumstances at the time, so I stepped down to being a sort of salaried role. But then I've reduced my days working, and I reduced them further, and then I started working with you guys because that was interesting. And I've been allowed to do that basically because I'm confident that actually I have sorted my longer term future out. And that's because, going back to what you said, I started early. And without, one of the things I liked about the first cohort of our wellbeing course is we start basics. We start with budgeting, because you go back to what you said about people dropping out. Why am I dropping out? Because I can't afford it, etc. We go back to budgeting, and actually, if you actually start looking at your financial information in a lot of detail, you probably realise you're spending stuff on things that you probably cut out. So who's got a Netflix subscription they took out years ago but still haven't cancelled and really don't watch it very often? Or and then you've got Disney Plus, and then you've got your etc., or you haven't looked at your Sky costs. It's just renewed over, and the premium's gone up from £40 a month to £80 a month, but you've not reassessed it. You haven't looked at your insurances. If you start looking at things like that and chipping them down, it suddenly gives you a bit of capacity, which means actually not stopping the pension becomes very affordable, and carrying on paying into it becomes very affordable. I can't emphasize enough please do not drop out early into the scheme, in the early years of you being employed out of the scheme, unless you've really 100% can't afford it and have 100% assessed all the expenses you've got.
Yeah, absolutely. I think, like, for me, just the power of having a plan, and with the spreadsheets, you can model these things based on historic numbers. So I kind of know, it's like you can peer into the future, and I know that I will have the option to retire early, and that just feels amazing. And I know how much I spend every month, and I know that I automatically invest the same amount each month, and it just happens automatically. I spend hardly any time managing my own personal finances, because I spent a long time learning to get good at it. So yeah, I think just starting early is a really good message. Of course, things like this YouTube video is helping everyone to start early. If you want to start early, come on our course. 10 hours, you could have a fully fledged financial plan. And more importantly, the big take home from our course is people just finally understand their finances. And that is just a really, really powerful position to be in because, not being funny, but doctors, pretty smart people. If we teach you the right things, this is so much easier than medicine. You just need to be taught the right things. And then you can understand your own finances. And that is just, the course is so rewarding for us. So first cohort, well underway, nearly finished. We are doing a second cohort because the first one was so insanely popular. If you want to come on the second cohort, check out the link in the description. I think it's medicsmoney.co.uk/course or courses. We'll also put the link to that little NHS retirement thing. Anything else that I've missed, I'm slightly conscious looking at the time. We've got to go to a meeting to plan out the next cohort of the course.
Yeah, no, I don't think we have. Yeah, we've covered a bit. Pension planning, key takeaways here. Retirement planning isn't all about pensions, but the NHS part is really core to this. So don't go and invest in Bitcoin and drop the NHS pension. Going early is really important because compounding is important. The compounding effect is important. Equally, probably something we haven't talked about. If you are starting to do investments elsewhere, ISAs and things like that, have a look at the charges that you're being charged on those products because they can be quite significant in some cases, a lot higher than other providers are providing. And if you have more charges going at your products, you're having the reverse of compounding going on. So you're actually having your investments reduce compared with where they can be. So have a look at that as well. Have a look at alternative options, but also, if you're one of those people that really thinks, I can't afford it, go back to basics. Start looking at all your outgoings at the moment and see if there are things you can cut which actually you've been paying for, you've forgotten about it, and review all those utility costs to make sure you're getting the best available prices to you. If you do all those kind of things, you'll be putting yourself on a good step forward for the future.
Yeah, absolutely. It's just like sometimes on YouTube when we say this, in the comments there's people in a blind panic, okay? In my view, my message is that yes, the game has changed a bit for doctors. We are being paid less than we were 20 years ago. And yes, the retirement age of the NHS pension has gone out. But if you start early and you've got a plan and you understand your options, in my view, none of that is an issue. You don't need to do anything absolutely crazy here. You just need to recognize that the game has changed versus our colleagues that are retiring now. And, all power to them. They've done their time in the NHS. The game has changed and you've got to change your game plan. But don't do anything wild, just good, sound financial management planning. Watching things like this already puts you way ahead. And if you want to get even further ahead, check out the comments for the course. We've definitely got to hit wrap up there because we're going to be late to the meeting. Yeah. But Andy, that was awesome. Thank you so much for that. It's great to have your wisdom on these kind of things. And of course, if you want more pearls of wisdom for Andy, you know where to come.
Yeah.
Awesome.